We have potentially a very important profit warning today. Shares of Darden are at a 10-month low after the restaurant operator cut its full-year guidance. Rachel Rothman is a restaurant analyst with Susquehanna Financial Group. She downgraded Darden last month from positive to neutral with an $58 price target, and she joins us now on the CNBC Newsline. Rachel, thank you for joining us. I appreciate it's suddenly become a busy morning for you.
Yeah, thank you, Simon. Thank you for having us.
What has gone wrong at Darden? The CEO, Clarence Otis, is saying, we had these promotions, they didn't resonate well, we need bolder changes at Red Lobster, Olive Garden and Longhorn Steakhouse. In your view, what is the problem?
I think you're bringing up a great point. They've spent the last couple of years trying to retool their menus, refocus on value, changing their pricing strategy, their limited time offers in an effort to re-engage with their core customer and drive positive traffic. Unfortunately, the efforts that they've unveiled to this point have yet to actually take hold, and so they are issuing a pretty big disappointment here, both for the quarter and for the full year, citing negative same-store sales at all of their core brands.
And sorry, I didn't mean to interrupt you. Is that partly because of the delayed rollout of the Olive Garden changes, or is it because they simply got it wrong? I mean, in October on the show, we discussed taking a seafood restaurant, Red Lobster, and putting increasingly non-seafood items on it because they were cheaper.
I'm not sure that I would say that they just got it wrong. I think I would say that they haven't figured out how to get it right yet. I don't think that it's about a delay. I think it's about them trying to figure out how to win back their core customer that is obviously choosing to go someplace else at this point, given the negative traffic trends. What you're going to need to be fearful of, though, is that they do highlight in the release that based on current trends and where they think their core customer's wallet is, they're going to need to focus even more on value. And as you know, it's pretty difficult to price discount your way to profitability and to growth.
Rachel, is it a problem with this price point that Darden exists in? I mean, who is Darden losing to if the consumers are not going to Olive Garden or Red Lobster?
I think you bring up a great point. The question should be asked, are people maybe trading up, those that are doing slightly better, into the realm of Cheesecake Factory if it were an evening occasion, or maybe into a Chipotle or a Panera if it were a lunchtime occasion? And then maybe some people are choosing to trade down into fast food, and so where you are is kind of in this mid-price point, which doesn't necessarily have a core customer for somebody to trade into it. So I think they are getting squeezed from both sides. Within casual dining, obviously they could be losing share to some competitors that have been showing positive same-store sales, and that would be something like Brinker, which owns Chili's.
Rachel, my concern would be that maybe we have a bigger problem now that is emerging. Brian Moynihan at Bank of America was talking about how small businesses may be impacted by the fiscal cliff. I interviewed Greg Badishkanian yesterday afternoon, and he's done hundreds of channel checks. He works in leisure, he works in the same area as you, and he warned me that he's now seeing softness. Take a listen.
What we're seeing now is October, November, a little bit of a slowdown. I think it's due to post-election blues, the fiscal cliff coming up. You had, to a lesser extent, the hurricane impact on the Northeast. When most of the companies report their fourth quarter sometime in January, I think they will probably see some sort of a modest slowdown versus that third quarter trend that we saw.
Rachel, let me take you specifically to a note out you have this morning on the cruise liners, where you're talking about the trends there, the pricing there, continuing to deteriorate at a time when Royal Caribbean is up 42% year to date. Carnival is up 19%. What do you make of that area now? Should people sell?
I guess I would say, in contrary to what your guest just said from Bank of America, we are actually seeing weakening signs across all four of our sectors. And as you know, we cover hospitality broadly, which is gaming, hotels, cruise lines, and the restaurants. So in each of our sectors, we've either seen the pace of gain slow or we've seen the pace of decline steepen. So we aren't seeing strong underlying macroeconomic trends from the consumer. And even RevPAR, which is hotel demand, is weakening here. So I actually agree with the analyst from Citi from yesterday. Right. We are seeing some weakening trends.
So just before we let you go, where is the greatest call to action in your view? Where should people focus most on their investments?
I guess if they have a very short-term horizon, which I think most of our clients do between now and year-end, right, December 31st, we would need to focus on something that had an actionable catalyst between now and year-end. And the only two companies that we cover that were set to report between now and year-end were going to be Carnival in the cruise space, which you just highlighted, and Darden, which just pre-announced today. So I think the Darden action just took place today. So what people in our space will now focus on will be the next catalyst, which is Carnival. And as you so adeptly highlighted, the setup into Carnival's earnings is not as good as it had been for investors at the second and third quarter because there is no sign of pricing improvement in year-end bookings, and we continue to see price cuts, and the stocks are up over 35% year to date.
For sure. Rachel, it's good to have you on the show. Thank you for joining us at short notice. Rachel Rothman there from Susquehanna.